Hi everyone. Thanks so much for joining. It is our market update. It is the start of a new week. Can you believe it? We are halfway through Q1 already. We're in the second half of Q1. This is crazy, but it's going to be a bit of a liquidity thinned week this week for two reasons. Number one, the US is out today because of President's Day. They're back tomorrow though, but it means US indices and treasuries are closed. You can still trade the dollar, you can still trade futures, no bother, but those live markets are closed. We also have Lunar New Year, which means that Chinese markets are closed for the entire week. So just something to consider when we're looking at what's going on. Let's get straight into the charts because that's ultimately why you're here. And as you can see, let's start with the good old classic, which is the world equity indexes. So if you just follow my pointer here, we are just looking at Europe because obviously the US is closed. Sea of green. Markets are kind of starting the week on a high. If we just move to the right here, you see the weekly performance from last week. Some clear underperformers and some clear outperformers, with the FTSE 100 being an outperformer and the Euro stocks being a clear underperformer. And that is because European stocks have a little bit more, or the Euro Stocks Index, I should say, which is the biggest 50 companies in Europe, has a bit more exposure to tech, to software firms, which are getting really hit hard, specifically last week with the AI scare trade, which I've spoken a bit about in recent weeks. Whereas the FTSE, it doesn't. It has all those defensive stocks that can kind of act as a bit of a barrier to that worry. But I think there are a few key trading themes as we start this week. We've got the continued fallout from the better US economic data from last week. So we had stronger payrolls and we also had more tamer US inflation essentially. So that scaled up hopes of a Fed rate hike. We're now about 2.5 rate cuts priced in for 2026. So we'll be looking to see if there can be a third at some point. I think that's what the markets will hope for, especially when Kevin Walsh takes the reins from Jerome Powell, but that's not until May. So we've got a few more meetings before that. We're also seeing a banking sector rebound. Now, the banking sector in Europe is a really important sector, certainly for the FTSE, but also for the Euro stocks. Hence, we're seeing this positive increase. If you remember last week, fears about AI basically taking over the whole of the finance sector and making it obsolete really caused a big decline in banks, but that is not the case today. And we're looking at a bit more detail. So banking sector rebound, they had their biggest decline since April last week. So markets are recovering from that AI fear trade a little bit as we start the new week. That maybe it's gone a bit too far too fast, that yes, it's easy to plug in all these AI plugins from Claude and whoever else, but actually you still need the big companies to have the data, the customers, the marketing teams, the sales teams, the people that, the managers. So it's not going to take over the world quite yet. And it's a bit of an easy solution. And essentially the AI trade is a great PR. There's a lot of PR around AI at the moment, and it's doing really well with its PR. Everyone's talking about it, but I think there's also quite a lot of, it's very easy to sell fear. And I always do say that. It's much harder to be a bull. I'm not saying that now is a good time necessarily, but valuations are looking very cheap, and we will talk about that. So we've got also this week, US-Iran tensions are in focus. Oil could be in focus. Money managers are long oil in their highest rate since nearly a year. So that suggests some kind of interesting change of view. Remember, oil's been a bit on the doldrums recently. Likewise, the dollar is a bit higher as we start the week, and there is political risks which are weighing on UK gilt yields. Now, let's just go into that banking sector theme. Now, I'm just looking at the movers today in the FTSE 100. They're at the top here if you follow my pointer. Just look at the names that are leading the way for the FTSE 100. NatWest up 4.5%. Barclays up 2.43%. 3i, which is another kind of wealth manager stroke PE company, that's up 1.69%. They are leading the way today. And that is because of this banking sector rebound. So maybe it's because the US is closed. Maybe it's because over the weekend there's been a lot of articles, a lot of updates about maybe things have gone a bit too far, too fast with AI, and that AI isn't going to, whilst it can manage all of the workload pretty well, it still needs people to operate. It still needs these big banks and everything from banks to software companies to logistics firms even on Friday. So it's just gone a bit too far too fast. AI is not going to take over the world that quickly. It's going to be very important for the world though, and important to work, and it will cause changes, but it won't necessarily eradicate all the companies that we've come to know and love in our portfolios. So hence that certainly those quality stocks, those banks, they are bouncing back. Now, as you can see, we've also got some increase in BAE Systems and Babcock. Those two are defense firms, and they are in focus today. In particular, we had the Munich Security Conference over the weekend. That was about the height of it, really, in terms of news that's impacting markets today. But then we had that Munich Security Conference, and Keir Starmer clearly said he wants a closer relationship between the US, between the UK and Europe, especially when it comes to trade, but also to defence. So defence names are really benefiting from that. He's going to try and push through and bring forward some extra defence spending as well. So hence we're seeing that play out in markets today. Now, if we take a look as well at commodities, commodity markets, bit of a mixed bag today. Got a bit of a small increase, Brent and WTI, following stocks higher, really. But look at this, another decline in gold and silver. Gold is now lost the 5,000 handle. It's down $44 so far today. I've got a chart up here. As you can see, still very much in that uptrend, but it's not really been able to sustain those gains that it saw at the very end of January. So we've had that kind of really volatile February for gold. It's still an uptrend, and you can see that we've made a series of higher lows, which is your technical definition of an uptrend. So we're seeing that play out in markets, but we have lost that 5,000 handle, and that is on the back of that economic data. So especially that inflation data in the US. If inflation is not a problem, you don't need gold as an inflation hedge. There's less fears about what the Fed are going to do, that they're going to cause a big inflation outbreak by hiking rates too quickly, cutting rates too quickly, I should say, not hiking. They're doing the complete opposite of that. But gold just not really in demand as much. And I think that we could, whilst it's still in this uptrend, if we were to fall below 4,900, I think that would be quite a bearish development in the short term. If I just pull up the moving averages as well, we can see a little bit more of the technicals on that chart. So we're very far away from any kind of key moving average support levels. 4,644. I think something quite bad would have to happen to that. As I said, start with 4,900. Then I think you've really lost short-term momentum to the upside. I just think as the economic data kind of improves and people start to focus maybe more on the fundamentals, then gold will become less of a focus. Also, it seems like we're returning to some bit of normality. We saw those huge inflows. You can just see it. Look at the size of the candles. We basically had a parabolic rise throughout January for gold. These huge candles, which is a real sign that the trend is having difficulties, and we continued through that for a number of days in February, but now it's smaller. Now we're kind of just maybe eking out gains or losses here and there. So it's finding more of an equilibrium, the precious metals. So I think that high volatility that we saw at the start of this month is really dissipating, and we did expect that, right? It doesn't last forever, that kind of the market behavior. But I think there's just, with the better inflation, we've also got UK inflation out this week. We've got US PCE as well at the end of the week, which is the Fed's preferred inflation measure. But I think there's like this sign that disinflation is still going on, and that's one less reason to hold, one less pillar really holding up the gold price there. So we're still close to the 5,000 handle, but we've dropped it right now. Okay, if we just look at the dollar as well. The dollar is really interesting. There was an increase in net shorts, with the dollar and net shorts. People are still net short. Now, there wasn't an increase in it last week. There was actually a decrease. So people are reducing their net short position, but we're still very short the dollar. The market is. This is the non-commercial futures positions, which essentially is speculative. So kind of the wider market, how they feel about the dollar, and people that are taking positions on the dollar and bets on where the dollar will go next. They seem to be still bearish, but they are improving. So as the dollar, if we go back to the dollar chart, as the dollar fell below that, it's obviously below its moving averages. You know what I say, when things are below their 200-day moving average, nothing good happens down there. But we're kind of hovering in this kind of holding pattern, really. It's getting very, very tight, that range. Look at it from last week. Dollar was weaker across the board. We'll look at that in a moment. But it has reclaimed the 97 handle in the dollar index. Still very, very weak, but is not as weak as it was at the end of January. We again have seemed to be a lot less volatile in recent days as well. So something to point out there, that the market is maybe just fatiguing a little bit with the short dollar trade. It does not mean that the dollar is going to rally, but it is fatiguing just a little bit. Maybe it's come back too far. I don't see us moving back to 100 anytime soon, but 98, that's definitely a possibility now that we're above 97. Those are the futures positions. I said I would show you the dollar's position against the G10. That's from the start of this month. As you can see, the only currency that's weaker, that's stronger, that's weaker against the dollar is the British pound. So the pound is the weakest G10 currency so far this year. That comes, certainly part of that is not only weak economic data, but more political risk as well. But just look at some of these gains against the dollar over the past month: 2% for the Norwegian krone, nearly 2% for the Aussie dollar, 1.5% for the Japanese yen, and even for the euro, a 0.5% gain. So, there were some big moves in just 2 weeks against the dollar. So maybe it's gone too far too fast. We've got a bit of fatigue coming in. So that's worth noting, because that de-dollarization theme, where people were selling US assets, maybe that's going to lose some traction as well. This movement in the dollar could have a bit of a broader fallout. So if there's less selling of the dollar, then that could mean that there's less selling of US stocks, which could see US stocks outperform. And if I just go back to that world equity market, look, last week we saw a big sell-off in US stocks. Obviously, the sell-off is very associated with AI and with tech and sectors linked to that. We know that there's a lot of tech, obviously, and software companies in the US, certainly compared to the UK, hence the outperformance of the FTSE 100 versus the NASDAQ and the S&P 500 and even the Dow Jones. I think what was notable last week was just that sell-off was just so broad-based. If we go deeper into this World Equity Market Index, we'll see there were a lot of declines last week, including small cap companies. So nothing was really out. Small cap companies may have outperformed the larger caps. They only fell 0.8% last week, but they were still down. So it was a bit of indiscriminate selling, which I think is worth pointing out. Bond yields as well, I want to talk to you about. So this is over the past month. Whilst there's been a lot of chatter, again, about de-dollarization, about people ditching treasuries, that is absolutely not seen in the data. This is the United States 10-year Treasury, and this is the yield. So the yield change, obviously they're closed today, so there's no yield change today. But over the past month, if you follow my pointer onto this right-hand side, you can see that yields are down by 17 basis points. So it's one of the top performers, along with France, in the world, globally. So US Treasuries performed really well over the last month, even though there's been talk about them being sold by Chinese investors in particular. But look at the clear underperformer, only a 0.4% drop in the 10-year gilt yield in the UK. That's that political risk premium, again, having been built in recent weeks. But if we look at the past month, as you can see, again, Treasuries, yields are falling. That means Treasury prices are rising. So Treasuries, big outperformer. But the UK actually performed very well last week as well. So that, as Keir Starmer's position was stabilised as Prime Minister, the Treasury market as well started following the gilt market started following the Treasury market higher as well. So just something to watch out there. As I've mentioned, a huge amount going on in markets at the moment, lots of themes going on. We're going to be watching to see if stock markets can recover, if that AI scare trade just loses a bit of momentum, because we think it's a bit overdone. Whilst AI is a reality and it's here to stay, we don't think it's necessarily going to gobble up all the jobs and all of the companies all at once. So we think that there's a bit of momentum there. So we would look for a bit of a recovery as well when the US come back tomorrow. And obviously we've got that a lot of UK data this week, including labour market, CPI and retail sales data. So CPI would be the real one to watch, especially with the pound being quite weak. We expect it to remain fairly weak this week because expected to see a big moderation in inflation. Now that could be good for gilt yields. Okay, guys, thank you so much for joining and speak to you soon.